I'm Bambi Francisco, and I'm continuing my discussion with Sharon Weinbar. She's a managing director at Scale Venture Partners. Sharon, there's been many reports about how the VC industry has to change and that there's something wrong with the structure. Do you think something's wrong with the venture industry?
Well, I think the biggest thing that's challenged the returns in the venture industry has been it's been too big. I mean, we're really, it's a handcrafted industry. The strong returns from the first internet bubble and the asset bubble in general caused money to flood into the venture business. So we went from about 0.5% of GDP annually invested in portfolio companies to, at the peak of the bubble, about 2%, and then it came back down to about 1%. But so still too much systemic money. And what that caused was too many funds, too many Me Too companies getting financed. Companies, even the best companies, didn't get the kind of traction that they did in, say, the earlier periods, because they had all these other little companies chasing after them. They had to compete and spend money. They had to compete to hire people. The prices of everything came up, and then that made the returns go down. So as the amount of money invested in VC funds, and then which we in turn invest less in portfolio companies, goes down and kind of right sizes relative to the whole size of the economy, the returns should return to, not the peak of what they were in the bubble, because that was a kind of crazy time, but in the mid-'80s to mid-'90s, you had the pooled top quartile return was about 5x return, which is a really strong return. So that's the average of the top 1/4 of all the venture funds in any given year. So 5x return is a really good return. So that's what we would like to see happen, going forward as a smaller industry.
So we did, I think, 31 billion in 2008, and maybe on track to do 60% of that.
Right.
So, but that's partly because there's really no choice, right? I mean, in terms of if what happens when you do have a choice, and we go back to 2010, spending upwards of 25 billion, 30 billion. I mean, is that
right? Well, what you're seeing, you are seeing funds. You're seing funds that had raised big funds go back and cut their fund size. I mean, for example, Highland Capital had their last fund was $800 million. Their new fund is $400 million. So that's an example. So you've got funds that are shrinking in size, and then you have a bunch of funds that are not raising follow-on funds. So they're still in business because they're still supporting their existing portfolio companies, but they're not raising a new fund, and so they're out of the market for making new investments and competing up the price that we pay to get into the investment, and having the portfolio companies compete amongst themselves for market share in a new market. And what it does is it winnows out a lot of the Me Too companies. I mean, I can tell you, an anecdote that just made me really scared for the venture business. In 2007, I had a friend who's a founder of one of our portfolio companies, started a Web 2.0 company. And it had a sort of amorphous business plan. It was kind of, we'll get people to do this and share with their friends. We're not really sure how we're going to make money, but we think we can get people to do this. And I was a personal reference for him because I've known him for a number of years. I was happy to do that. But the funds who were interested in investing in it, because it wasn't that pristine of a business plan, there were small funds who were in many cases chasing after the deal because, literally, to quote one of them, said, "We have to get some of this Web 2.0 stuff."
Right.
And you just think, stuff. It's sort of like, I don't know if it's, I don't know what it is, but it looks good. Other people seem to be making money. I want to pour money into it too. And that's how you end up with 30 startups going after each market segment, and that just spoils the whole industry. And that, so hopefully that part is going to get pulled out of the system and let the really good companies thrive.
So it sounds like there doesn't really need to be any change besides just fewer dollars going into investments.
Well, that's yeah. So
and maybe some VCs
capital markets theory would show that increased supply of capital leads to decreased returns. So that that's probably the single biggest thing. One of the other structural changes that is happening is most funds are getting smaller, or at least not growing. And so that when you have funds that are very large, yet still going after relatively early stage opportunities, just the way the funds work and the number of people employed there and the way they have to think about returns, often the business model of that fund is to invest a lot of capital per company.
Right,
and
right.
that just, again, tends to drive down returns.
Right.
It's very, billion-dollar exits are really few and far between. I mean, we can remember them, but relative to the number of companies that get funded, they're
Right.
very small. And so, if you're investing $50 million or $100 million into a portfolio company, you're not really likely to get a billion-dollar exit, and that drags down the returns too. So as the fund sizes individually are smaller, we can all put less money to work in an individual company, and then that company has a better chance of making a return of the capital.
Right, right. Okay. Well, Sharon, you're going to talk about your expertise is in local. Well, I'm sure that's just part of your expertise. But so our next interview, you're going to talk about the local industry and the opportunities there.
Okay, thanks.
I've been speaking with Sharon Weinbar. She's a managing director at Scale Venture Partners. I'm Bambi Francisco.